welcome to our video update for April 2024. I'm Mike Halla of Michael E Halla and Associates, and we are delighted to have you here to share current news regarding the U.S. markets. Anticipations of aggressive interest rate cuts by the Federal Reserve this year have been a driving force behind the soaring stock market, pushing it to reach successive record highs. However, as the rationale for rate cuts weakens, scrutiny over the bull market intensifies. Concerns are mounting among some investors regarding the sustainability of future stock market gains. A recent inflation report has exacerbated worries, prompting questions about the Federal Reserve's ability to implement rate cuts this year without indicating an economic slowdown. Initially, Wall Street had projected as many as 6 or 7 interest rate cuts through 2024. But now, doubts are emerging regarding the likelihood of any rate reductions by the Fed. Such skepticism could potentially spell trouble for stocks. The yield on the key 10-year Treasury note concluded the week at 4.49%, experiencing its most significant single-day surge since 2022 on Wednesday. These escalating yields diminish the appeal of stocks compared to holding onto Treasuries until maturity. Moreover, they contribute to increased borrowing costs across the board, affecting everything from corporate debt to mortgages and car loans. Here are some areas of the stock market that are currently vulnerable to higher rates. The small cap sector last week witnessed a sharp decline of 3% in the small cap focused S&P 600 index, with Wednesday alone marking a significant 2.9% plummet following the release of the inflation report, marking the steepest single-day percentage drop since February. Small cap companies, largely dependent on domestic revenue streams, are particularly sensitive to economic shifts. One significant factor contributing to their vulnerability is the proportion of operating profit allocated to servicing debt interest, which tends to be much higher for small cap stocks compared to their larger counterparts. According to Dow Jones market data, the operating income to interest expense ratio within the S&P 600 stood at 2.3 times as of March, significantly lower than the 7.6 times for the S&P 500 companies. Moreover, small cap firms often rely more on floating rate debt, exposing them to fluctuations in benchmark interest rates. As rates rise, so do their interest expenses, impacting on their bottom line and increasing the risk of defaults. Data from Lazard Asset Management reveals that approximately 44% of debt among companies in the Russell 2000, another small cap index, was floating rate at the close of last year, in stark contrast to the 10% among S&P 500 firms. This heightened exposure exacerbates their susceptibility to interest rate fluctuations. Furthermore, a concerning trend emerges as approximately 40% of companies in the Russell 2000 reported no profit over the past year, as opposed to only 10% within the S&P 500. According to J.P. Morgan Asset Management, this disparity underscores the precarious financial position of many small cap companies amidst economic uncertainty. The tech stocks have been leading the market's growth since early 2023, driven by a surge in investor excitement for artificial intelligence technology. The biggest tech companies boast strong financial foundations and hefty cash reserves, which should shield them from the impact of rising interest rates. However, there's concern among some investors that if market sentiment sours, the popularity of tech stocks could turn into a liability. The information technology sector of the S&P 500 makes up nearly 30% of the index's total value, making it more than twice the size of any other sector. If investors decide to cash out, tech stocks are likely candidates for profit taking. Back in 2022, when the Federal Reserve began increasing interest rates, the tech sector suffered a 30% decline, while the consumer discretionary sector, home to giants like Amazon.com and Tesla, saw a nearly 40% drop. The banking sector, rising interest rates prompt depositors to seek higher returns by moving their money to treasury bonds and money market funds, leading to reduced deposits at banks. Consequently, banks must offer more interest to attract depositors, which cuts into the profits of smaller and mid-sized banks. For instance, Wells Fargo expects its profit from lending or net interest income to decrease by 7 to 9% in 2024. Moreover, if interest rates remain high, delinquency rates on loans could rise, resulting in increased losses for banks. Higher interest rates have also pushed mortgage rates back up to around 7%, deterring potential home buyers and causing a sharp decline in mortgage activity at major banks, which impacts their revenue. As a result, the real estate sector of the S&P 500 has suffered a 7.2% decline this year, making it the worst performing segment and the only one in the negative. Smaller banks have been hit harder by the fluctuating rates than larger ones, while heavyweight banks like JP Morgan have seen a 2.1% increase in the KBW Nasdaq Bank Index. Regional banking stocks have plummeted by 13%. Finally, looking at the energy sector, oil and gas company stocks are experiencing a resurgence following their stellar performance in 2022. As oil prices climb, revenue for these companies receives a significant boost. Moreover, major players in the sector, such as Exxon and Chevron, are trading at a discount compared to the broader market, with price-to-earnings ratios of approximately 13 and 12 times their earnings over the past 12 months, respectively. In contrast, the S&P 500 is trading at a higher ratio of around 20 times earnings. Additionally, the S&P 500 energy sector has surged by almost 10% in the past month, outperforming every other segment of the index by a margin of at least 3 percentage points. Stay informed and prepared as we navigate this financial journey together. Remember, the insights I've provided are not personalized advice. If you're looking for guidance tailored to your specific financial situation, don't hesitate to contact us at 920-686-7526. I'm Mike Halla from Michael E Halla and Associates, signing off until next time. Take care.